is Monday, February 26, 2024. So glad that you are here this beautiful Monday morning. Lots to go over. We always go over the new listing to pending ratio, see what's happening with the market. This is a huge week for the market. We've got a lot of economic data that will be released later on this week. We're going to talk about that. The bond market is already reacting in a not so positive way. We'll talk about that. Let's go ahead and start updating our new listing to pending ratio. First thing we're going to do is go backwards in time. Take a look at all of the agents that updated their pending properties late. First thing we're going to do is update the open house. We're at 2368, 2,368 open house. Open homes, open houses, open home. You know what I'm talking about. 2,368. That's a pretty big increase from the previous week of 2,107. Let's go ahead and start updating the pending for the previous few weeks. As you know, we always focus on the 6-county area, and that's going to be Travis, Williamson, Bastrop, Hayes, and Burnett County. We're going to go from the 12th all the way to the 19th and take a look at pending. Everything else is locked, but pendings will update for the next few weeks. This number comes in at 439. So 0.73 ratio, that is not bad at all. Let's go ahead and take a look at the previous week. That's going to be 506. 0.92 ratio, previous week from the 29th to the 5th. That's going to be 532. Builders are horrible when it comes to updating the pendings. This is going to be 544. Let's keep on going. And then we're going to go 15th to the 22nd. That's going to be 533. We're going to go from January 8th through the 15th. That's going to be 478. So let's keep on going. Let's see how far back agents are failing to update the information. So there you have it. So now we've got the latest and greatest going backwards in time. And you can see this pretty big increase in the number of listings, the difference between the number of listings that are new plus back on the market. And what we do is we subtract that to the properties that went active, under contract, and pending. That's going to give you this number. And then the ratio is simply the division of that. So we're going to divide the properties that are new on the market versus the properties that have gone under contract. A 1.000 is the perfect market equilibrium. The number of new listings and back on the market that came on the market are exactly the same as the number of listings that went active, under contract, and pending. That's going to give you that perfect market equilibrium, meaning that for every property that came on the market, the same number of properties left the market. Anything under 1 means we had less properties that left the market. That means that inventory increases when we have a number under 1. When you have a number over 1, that's a hotter market. That's why it's in red. Blue is a cooler market. Anything over 1, that means that more properties went under contract versus the properties that came on the market. So we're at 0.73 for the previous week. Let's start updating this week and see what's going on from the 19th all the way through the 26th. Keep in mind that the new price increase, price decrease, back on the market, active, under contract, will all lock at 11:59 p.m. tonight. And as you saw earlier, pending, we will update that for the next 6 to 8 weeks. But everything else locks at 11:59 tonight. So let's take a look at the number of new listings. That comes in at 940. Number of price increases, we're at 213. Number of price decreases, we're at 923, 81%. Quite a bit less than the previous week at 86%, a little bit higher than the week before that, February 5th through the 24th, or through the 12th, 5th through the 12th, came in at 79%. Let's take a look at back on the market. We are at 171 back on the market. That's 18%. So low numbers, especially compared to what we had back in November. A very low number back on the market. Active under contract, we are at 524 active under contract, 524. Now, go ahead and guess how many pending, you all. How many pending? What is your guess on the number of pending properties last week? We had 439. Austin at 338.5. I love the 0.5. Seth is coming in at a very bearish 279. Okay, so keep on going. So what do y'all think? Let's get 3 more guesses going. 338.5, 279. Let's get 3 more guesses going. We've got 300, Joe, 207, Melanie, Price. We've got Kristen at 305, Rob at 334. And the winner would be Seth, because Joe went over. So when the Price is Right, Seth would come in as the winner because the number came in at 299. Joe, you were off by 1. So therefore, Seth is the winner. 299. I'm excited with this number. It's a positive number. I mean, we've got 0.74 ratio right now, better than the previous week. And we know that this number is going to go up. So even though rates have gone up, the average rate for the previous week was 6.77. The average ratio for this week, 6.9. Demand actually increased. Now, as a ratio, demand increased. But take a look at that. Look at that listing difference. 1,100 the week before, 940 this past week. Number of listings dropped a little bit. Now, it is 10:13 a.m., so we're going to see quite a few listings come on the market between now and the end of the day, but nowhere close to the number of listings compared to the week before. Let's take a look at some comparison right here. Let me go ahead and just kind of clean up the screen. And let me drag this down so you can see the comparison. There you have it. Let me adjust this a little bit for you so that when I publish this as a PDF, you can see the whole thing. So we have already, so last week, take a look at last week, 256 additional listings came in the market the prior week versus a year ago. Already, we have 116 listings that have come on the market this past week compared to a year ago. That's a 14.1% increase. 54 more price increases already this past week compared to a year ago. 75 less price drops, 62 less back on the market, 23 more active under contract, and so far, 269 less properties have gone pending. But we know this number is going to decrease, meaning the number of pending properties this past week will increase dramatically as agents and builders update the MLS. But take a look at that ratio. Well, a year ago, the ratio was 1.01. For the previous week, a year ago, the ratio was 0.96. It came in at 0.73. This year, the ratio 0.74 so far. Last year, the ratio was 1.01. So even though we've seen a pretty dramatic increase in demand in better ratios, I mean, January 1st, we're at 0.68, and these look very positive, especially when we compare with July all the way through November, and then things improved. We had one bad ratio, but that was January 1st. That's pretty common. So even though the ratio is a dramatic improvement over what we've gotten used to from, go back to May, from May all the way through November. Yeah, the market was brutal. It was a cold market. Buyers were not moving. We had an improvement in interest rates, and you can see it got pretty bad on rates, got up to close to 8%. And that's when the market got really nice and cold. It was 7.86%, the ratio at 0.71, nice and chilly. And then rates started going down. And what happened? We started noticing a pickup in demand. Well, now rates have gone up a little bit and demand slowed down a little bit. Let's start updating the monthly and see what's going on in the context of the entire month. First thing I want to do is update January. I want to look at pending properties for the month of January to see if we have to update anything. We do. It comes in at $17.99. Do we have to update anything for the month of December? Let's go ahead and select all of December. Comes in at $15.11. We do not have to update anything for the month of December. So now we can start updating February. Number of new listings, oh, wow. Okay, so last month we had 3,191 listings. February 2023, we had 2,829 listings. February 2024, you all, so far this month, we had 3,403 listings. That is substantial. I mean, and we're only on the 26th. We still have 26, 27, 28, 29. We still have 3 days left for properties to come on the market. I mean, we're going to cross the 3,500 listing mark. And last year, we had 28, 29. Now, part of that, we had brutal weather last year, so some of those listings got bumped out to March. March was a very high listing month, so we're going to have to see how things play out March. But 3,403 so far in February, that is pretty decent. That's a lot of listings. Let's go to price increase. We are at 741 price increases. Let's take a look at price decreases. We're at 2,990. 80%, that is the lowest percentage that we have seen since May of 2022 when the market peaked. Market peaked May 2022, and we had 80% price decrease. Right now we're at 80% price decrease. Not as many price decreases as we were having back in August, September, October timeframe. That number just plummeted. Let's take a look at back on the market. What's going on? We've got 593 back on the market. That's 17%. Best ratio we've had since April of 2023, 17%. Active under contract, we're looking at 1,587. And pending. Let's take a look at pending. We're at 1,354. Oh, that'd be nice, wouldn't it? 1,354. So we're at a 0.74 ratio right now for the month of February. February of last year, we were at a 0.95 ratio. We're at a 0.74 ratio. So 1,055 additional listings have just stayed on the market. So inventory is increasing. Anytime you see a positive, a consistent positive new listing to pending ratio, this is a leading indicator. What does that tell us? That inventory will increase, and inventory is indeed increasing. Let's take a look at closed. So far this month, we're at 1,694 closed, and withdrawn, we are at 351 withdrawn. Expired, we're at 178 expired. How do we compare month over month? So already we have 212 month over month additional listings this month that we had compared to last month. And let's look at a few other ones. Let's take a look at year over year. Year over year, we already have year over year 20.3% more listings February 2024 compared to February 2023. Michael said, do you think we'll break 2,000 closings this month? All right, so we're at 1,694 closings. Do I think we're going to break 2,000 closings this month? Yes. Yes, I do. I do think we're going to break 2,000 closings this month. In my opinion, it's going to be better than January. When you look at the number of pending properties, January was a really nice and positive month for pending properties. You had 1,680 properties go active under contract, 1,799 properties go pending. 3,479. And that's just the best number we've had going all the way back to August, September timeframe. And when you look at these 3,100 pendings, look at how many closings you had in the following months. All right, 2,500, 2,300, 2,100. So I would say, yes, we are going to cross the 2,000 closing mark. It is a shorter month, so we're going to have, not only is it a shorter month, but the last day of the month is on a Thursday. So we're going to, and even at Team Price, I can say that from our own personal book of business of us as a team, we've got a lot of closings going on both on Wednesday and Thursday. Just everyone just packed in all of these closings towards the middle of this week, towards the end of the month. So I would say yes, Michael, we are going to cross. Let's see if anything updated on the number of closings for the previous month. Let's go January. And we're at, 1,039. So we had one additional closing, 1,939, 1,939. So there, one additional closing. So I'd say yes, we are going to cross the 2,000 closing mark. My prediction, and let me go ahead and show you insight and statistics, and we're going to go to the sales density. I just updated this information this morning. My prediction, 2,050. 2,050. That's going to be my prediction. It's going to be off by, I'd say, 1%, 2%. But 2,050 is my prediction so far for this month, is that we're not going to beat February of 2023, but we will beat January 2024. So that's my personal prediction on how many closings this month. So very good question. So, of course, we're going to make all this information available on the drive. So I'll update this and give you the link later on today. Let me go ahead and save this to make sure that we have everything. And excuse me, let me go ahead and update the bond market, show you what's happening with the bond market. We are up 3.2 basis points here so far today in the bond market. Let me just get this entire screen updated for you so you can see the entire thing. So we started exactly where we ended on Friday. And you can see on Friday, we had our team meeting right around there. And then we had a massive improvement in the bond market. So that was really exciting on Friday. We, in essence, reversed 2 days worth of gains in the yield. And then so far today, we are up 3.2 basis points. Now, it's going to be a huge day or huge week for the economy. So far, building permits, we're 1.489 million building permits. That is down 0.3% month over month. The expectation was that it was going to be down 1.5% month over month. So we beat the expectation. New home sales, the forecast month over month was up 3%, actually came in at a disappointing 661,000, worse than expected, came in at a 1.5. And then this was revised. So the previous new home sales was 664,000. It was revised down to 651,000. The Dallas Fed Business Manufacturing Index came in negative 11.3, better than the previous. We've got a few auctions going on. 6-month auction, 2-year auction happens in only 4 minutes. But the big one is going to be later on this week with GDP and then PCE, personal consumption expenditure. And the bond market could go both ways. We have no idea what's going to happen. With this gain that we've experienced, what's my advice for clients right now? Lock and float. Robert the Faithful sent over his rate sheet. So let me go ahead and just pull this up. As of this morning, what are we looking at here? We're looking at 6.625 for conventional 30-year, 6.375 conventional 15-year, 6.25 for FHA 30-year, VA 30-year, USDA 30-year, 7% for jumbo, and then 7.375 investor conventional 20% down, including one additional point. So 6.625 conventional 30-year prices held what we had on Friday, and that was that really nice improvement that we noticed on Friday. A little bit of a pullback. Let's see how far we are from a repricing. Rates are not going to reprice until it crosses this red line. That's when we're going to notice lenders starting to reprice some rates. So we've got a ways to go to see whether or not rates are going to reprice. But the big one is going to be both a combination of more so on Wednesday. Wednesday, we've got core PC price. That is huge. Corporate profits, GDP. These are preliminary GDP releases, but the market's really going to look at this very carefully. We've got FOMC member Williams. He is speaking at 11:45 on Wednesday. I really like when FOMC member Williams speaks because he just shoots us straight. The big one is going to be Thursday, personal consumption expenditure. That is what the Fed uses as an inflation indicator. Of course, they look at CPI, they look at PPI, but their favorite number is going to be PCE, personal consumption expenditure. If this number comes in hotter than expected, what can we expect on the bond market? You can expect yields to go up because that's going to signal that the Fed has not won their inflation fight. So we do not want this number. We want either to meet expectation or beat expectation. We do not want these numbers to go the other way. That's what happened with CPI, Consumer Price Index. That's what happened with PPI, Producer Price Index. So we had really bad news on those two inflation indicators. So we are hoping that PCE pricing will go the opposite way. Will it? I don't think it will. I think it's going to come in hotter than expected. That's my personal opinion on it. I hope I am wrong, but I think it's going to come in hotter than expected, and that's going to cause the yield to go up. If I had to put my money somewhere, I would say that we're going to have worse than expected PCE numbers, and that it's going to cause the yield to go up. So what would I do if I were a buyer right now? I would lock and float, because if I'm wrong and we have better than expected PCE numbers, well, then you can just float your rate down to a better rate. But as of now, simply based on the CPI and PPI data, you can expect rates to go up. That's my personal opinion. I hope I am wrong. Let's take a look at the inventory level, see what's going on. Michael said, where can I find Robert's rate sheet? Number one, it's emailed to you. So I always include it as part of, even if you look at the previous emails that I sent out with my daily recap, I do include his rate sheet. So that's one place that you can find it. Second, we always upload this information to the drive. So if you go inside the drive and you go team price folder, working with buyers, scroll all the way down, weekly rate update, go to 2024, you're going to see all of the weekly rate sheets. So let me go team price folder. Then you're going to go working with buyers. Then you're going to go weekly rate update, 2024, and hear all his updates. You're going to be able to find every single one of his updates, even today's update. There's today's update. So that's where you can find it. Does that answer your question? Okay, good stuff. Good stuff. And I don't know why this one is here. Let's go ahead and move it 2023. So there you have it. 2000, and we've got all the rates going back to 2018. This is where I just dump everything, and you can see all of his rates right here. Let's take a look at the inventory, see what's happening with inventory here in the entire MLS. Let me go ahead and just make this a little bit bigger so that you can see the entire thing. I want to remind you all that I sent over the contract proficiency challenge on Friday. That's going to be a pretty unique one. So go ahead and just do that one. It's a really good one. So I want to encourage you to do the contract proficiency challenge for the week. There are 10,208 properties currently on the market. That is an increase from Friday of 70. That is a weekly change of 74, a monthly change of 403. So we've got a month-over-month increase of 4.11%. And we've got a year-over-year increase of 12.3%. We have 12.3% more active listings on the market today than we had exactly 1 year ago. There are 4,575 pending listings currently on the market. That's going to give us a very decent 30.95% activity index. And as a bonus question, what is the formula for the activity index? It is my favorite leading indicator. It's going to tell me everything I need to know for any kind of market. What is my favorite? What is the formula for the activity index? You can unmute yourself. You can write it over chat. What is the formula for the activity index? activity index formula. Yes, indeed. Pending divided by active plus pending. Let me show you something. Let me go ahead and show you something really quick. It's important for us to know this. The reason why I like the activity index, it's so easy to pull this information up. Give me a subdivision, you all. Give me any subdivision. Write down, first person that writes down a subdivision. Give me any subdivision. Olympic Heights. Great. So this is what I'm going to do. I'm going to go to residential, and I'm going to go asterisk, Olympic, H, asterisk. So we've got Olympic H, asterisk. Olympic Heights. Olympic. No active properties? Are there any active under contract? Okay, so well, it's 100% activity index because there's no active properties. So that was easy. Only 3 pendings and no active, 100% activity index. That was easy. Give me another subdivision. Another subdivision. I'm going to even do the, okay, Easton Park. Good stuff. Easton. Let me just do Easton P. So what is the activity index for Easton Park? This is what I'm going to do. It's pending divided by active plus pending, right? So first thing I'm going to do, grab my little electronic abacus, and I'm going to go and select active under contract and pending. So how many properties are active under contract and pending? 40. So I'm going to go 40 divided by, and then I'm just going to click on active, and it's going to give me 108. And I'm just going to go 108. And that's going to give me an activity index of 37%. So right now, I can tell you that it is a warm neighborhood. Months of inventory ought to be less than 4 months of inventory. I'd say close to 3, possibly into the 2.5 to 3 months of inventory. Well, let's validate that. So what I'm going to do is take a look at the active. How many active do we have? 68. How many sold over the past 90 days? 29. So if we've got 29 divided by 3, we've got 9.6. And how many active? We've got 68. Oh, this is interesting. 68 divided by 9.6. Okay, so we've got, oh, this is a really good test case. So we've got 7.08 months of inventory. But we've got an activity index of 37%. So what does that tell you? The lagging indicator is really bad because over the past 90 days, only 29 properties sold. So the lagging indicator shows you that it was a cooler market in the behind us. But what is the market like? What's the market right now in Easton Park? Now, there's a lot of new construction properties in Easton Park. So what I want to do is I want to exclude the new construction, and let's test this out without using new construction. So I'm going to go resale. I'm just going to select resale. So now we've got 4 properties that closed in the past 90 days on resale. And how many resale active? We've got 15. Oh, this is interesting. So if we've got 4 divided by 3, that is 1.3. And we've got 15 divided by 1.3. We've got 11.5 months of inventory on resale. But what's happening with the activity index in Easton Park for resale? So we've got pending, that's 10. Okay, so 10 divided by 25. Okay, so that's a 40% activity index. 40% activity index, but months of inventory is north of 10 months of inventory. So if I'm looking at Easton Park, this is the classic indicator that what's happening now is way hotter than what happened 3 months ago. 3 months ago, it was absolutely dead. But right now, you've got 10 properties under contract, and you've got 15 properties that are active. This is on the resale side of things. So the lagging indicator is super cold. The leading indicator is warm, inching towards hot. 30% activity or 40% activity index on resale. Product is moving in Easton Park. And yet the lagging indicator shows you that months of inventory is super high because it looks at the activity of what happened in the past, not what's happening right now. So if I'm working with a buyer in Easton Park right now, what am I telling that buyer? Yeah, 90 days ago, it was absolutely dead. Nothing was moving. And that is why months of inventory is really high. But the activity right now at 40% is very positive. It is a warm market. So if the activity index stays around the 35 to 40%, what's going to happen to months of inventory 60 days, 90 days from now? It'll go from 11 months of inventory down to 3 to 4 months of inventory, because now the lagging indicator is going to reflect what happened in the past 90 days. And right now, the demand is really high for Easton Park. So this is the classic reason on why you've got to rely on leading indicators like an activity index. The other nice thing about the activity index, you all, is that you can just select anything you want. You can go to map and you can draw a radius. So let's pick, I'm going to pick on South Austin this time. So let's say you've got a client looking right here around the Tanglewood Forest area. And I'm just going to draw a 1 mile radius. So there's that 1 mile radius. So what is the activity index within this 1 mile radius? Okay, so I'm going to go active under contract and pending. That's going to give me 14. So I'm going to grab 14 divided by 29. That's a 48% activity index. That's amazing. That's great. 48% activity index, high demand. Properties are going under contract. Now let's take a look at months of inventory. So we're going to grab closing. So we've got 35 properties closed in the past 90 days, 35 divided by 3. So we're averaging 11.6 closings per month. And then we've got only 15 properties that are active. So 15 divided by 11.6. 15 divided by 11.6. 1.29 months of inventory. You see, a fairly close activity index compared to Easton Park. Easton Park, 11 months of inventory. This area, 1.29 months of inventory. So what does that tell me about this area? Well, it was hot 90 days ago, and it's hot right now. The demand for this area hasn't changed. It's a hot area no matter what. And you can do the activity index by selecting any and every area. It's what I absolutely love about activity index. The other thing is that you can do it for properties that are currently for lease. A team price agent asked me, hey, should I advertise this specific lease on Facebook or on Craigslist or on Zillow? And I'm like, well, what's the activity index for that specific area? Well, and that's the nice thing about it. Let's just grab this little Stastny, William Cannon area, and I'm going to draw what is the demand for lease properties in this area. So we selected the area, and we've got active under contract plus pending. We've got 6. So 6 divided by 28. Oh. So pending divided by active plus pending. 6 divided by 28. 21% activity index. That's a little bit on the cooler side of things. That ought to give us over 4 months of inventory as a lagging indicator, as a future lagging indicator. Well, so what's the inventory like that right now? So what's the inventory there right now? So we've got 30 properties leased in the past 90 days. So that's 10 a month. And how many active? We've got 22. 2.2 months of inventory. So what does that tell us? Well, it was 2.2 months of inventory. It was a lot hotter over the past 90 days. Inventory has gone up. Activity has gone down. So the lagging indicator is softer. It's hotter. The leading indicator is a lot softer. That's what that tells us right now. So if I'm working with a tenant right there, I'm like, well, we've got a better chance to get a property now than we did 90 days ago, because months of inventory really low 90 days ago, but the activity index right now is on the cooler side of things. So demand has slowed down in this area right now. That's important as you are pricing listings, as you are listing properties for sale and for lease. You ought to be obsessed with the activity index. If you only rely on absorption that happened in the past, you're relying on activity of 90 days ago, 120 days ago. So you've got to be obsessed with what is the level of activity right now. I could care less about months of inventory. Everyone loves months of inventory, months of inventory. That is such a lagging indicator. I care about what is happening right now. What is the demand like right now? So you've got to have this memorized: pending divided by active plus pending. And I just wanted to show you a few ways to use the activity index to your benefit when you are working with clients. So we've got an activity index across the entire city at 30.95. Michael said, thank you for going through that exercise. Very helpful, both on sale and lease. Yeah, you can do it unimproved property. You can do all kinds of things. You know, do a map lasso, do whatever you want. So I love, love, love activity index. We've got 3.57 months of inventory. Special listing condition. We've got 325 properties that have a special listing condition. 4 properties have a notice of default, 15 short sale, 4 pre-foreclosure, 4 in foreclosure, 2 auction, only 1 bankruptcy, 76 real estate owned, 188 estate, and 23 probate. So there's the breakdown. On resale, the activity index is 27.95. On new construction, it's 35.62. Demand on new construction continues to exceed demand for resale properties when you look at the activity index. As you can see, activity index has improved dramatically since the second week of November 2023. Months of inventory is starting to creep up a little bit, and that's because we're getting more and more listings hit the market. Now, take a look at this one. This is the monthly change in new listings 2024 compared to the same time in 2023. The monthly change on the number of new listings. Well, what does this mean? So right now, month over month, we're up about 200 and let me get you the exact number. We're actually up 403 month over month. And when you look at the number of new listings, last year, we were down. So we were in the negative. So here we've got 2024, and then here we've got 2023. So we were tracking really nicely year over year, and then everything split towards the middle of February, February 10th or so. And now this year, inventory is increasing at a higher rate than last year. That's what this graph right here is going to show you. Now we can see that pendings are going up. That's the seasonality of real estate. Pendings for our market tends to peak towards the latter part of April, beginning of May, and then those properties start closing and pendings go all the way down to January, and then it reverses. So pendings are going up. Active listings are also going up. So we're currently at 10,208 active listings. We're at 4,575 pending listings. 44.8% of the 10,208 active listings on the market have had a price drop. Let's take a look at a few other things. Let's go to market cycle. And let's just see what's happening with pricing. Let me download this so you can see the entire PDF. There's my projection for the month, 2,050 properties. That's what I expect the number of properties to sell for February 2024. That's going to be an increase month over month of 17.5%, but a decrease of 5.9% year over year. So far this month, the average sold price stands at a very healthy $575,589. That's an increase of $39,414 month over month, a 7.4% increase month over month, which is just amazing. That is an incredible number. A 7.3% increase year over year. We finally broke the 14-month trend of a year-over-year price decline. We've been experiencing year-over-year price decline since November of 2022. That is now over. We now have a 7.3% price increase year over year. That's just amazing. On the median side of things, we're holding steady at $450,000. That's a 5% increase month over month and a very healthy 3.4% increase year over year. Prices are still down by 15.6% on the average side. On the median side, 18.18%. But we have made incredible and substantial gains when it comes to pricing. So far this year, the average sold price for every single property this year, all 3,795 properties that closed, stands at $555,881. On the median side of things, $439,201. Let's take a look at the sold price to list price ratio. This is a good one for us to review, sold price to list price ratio, because that is also improving dramatically. So your buyers are not going to have as much leverage going under list price compared to what we've gotten used to over the past few months. Are higher price listings moving and lifting the average sold price and the median sold price? It's a very good question, Oliver. And the answer to that question is everything is moving. Every single thing is moving across the board. So it's not only that we have higher price properties moving, that is happening, but we've got less cheaper properties selling because they've already sold. That, sellers are like, I'm not going to drop the price any further. And buyers are like, I don't think the prices are going to drop any further. So buyers are moving on product. We've got less properties going down on price, and we went over that on this one, 44.8%. We got up to like almost 55%. Now we're at 44.8%. So less properties are experiencing dramatic price drops. And, a high tide floats all boats, right? So everything is moving up across all price points. I would even say that the 25th percentile of the market is accounting for most of this change, not the 90th percentile of the market. The luxury, ultra luxury is not accounting for this big shift. It's the 25th percentile of the market. That's what's accounting for this pretty dramatic shift. Does that make sense? Which, buyers are acting. I would say the entire market is realizing that rates are not going to go back to 3%. Everyone realizes this. Now they're saying, okay, this is fine. Like I'm good with this. They're realizing, let me just be happy with this rate. That's what the market has accepted right now. But across the board, we're noticing a lot of the price points going up year over year when you look at the percentile change. And it's all, and let me prove that to you because I like to prove things to you. Here is the percentile analysis. Let me go ahead and just download this and show you this. Because do not give your opinion when data proves a fact. And let me go to this one. So take a look at Del Valle. Every single price point is up. We've got the 10th percentile, both the price and the price per foot. Everything is up. We've got Dripping Springs. Everything is up. We've got Elgin. The only one that's down by is the price per foot, but the best performing price point in Elgin, what is it? It's the 10th percentile. That's the best performing price point in Elgin. Now, we also have a really nice performance right here on the 98th percentile, but not as much as the 10th percentile. Let's take a look at a few other ones. We've got Manchac on the price per foot, up dramatically. So it's across the board. Look at Smithfield, 29.8%. Now, Wimberley, the 75th percentile, just absolutely killed it at 111.2, but we've got across the board increases. Let's take a look at zip code. Here's zip code, 78704. What's the best performing price point? The 10th percentile and the 25th percentile. What's the worst performing price point? The 90th percentile. Look at 78702. Across the board, very good at the 90th, but across the board. Look at 78723. Best two price points, 10 and 25th percentile. So across the board, things are improving. But if you were to plot all of this out, the best performing price points are the 25th percentile and under price points. Year over year, that's the best performing price point. Does that make sense? I mean, look at 7746. I mean, 102.8% year over year increase on the price. I mean, this is unbelievable for that specific price point, but it's happening across the board. Very good question, Oliver. A very, very in-depth analysis question. So I appreciate you asking this question. Excellent, excellent question. Let us go back to the sold to list price ratio. Sold to list price ratio for sold price to final list price, 97.16%. Sold price to original list price, 93.24. The original versus the final difference at 3.9%. We bottomed out at 6.3%. That was December 2022. That's when the difference between the original price and the final price was at its greatest, December 2022. We're now at 3.9%. What does that tell us? Not as many price drops. That's what this tells us. That we're not, the gap between the original list price and the final list price in comparison to the sold price is now shrinking. That tells us that we don't have as much aggressive price drops on the market. It's shrinking. We're not going from the original at 500 down to 350, sold for 349. That is now shrinking. There we've got 97.2% sold to list price ratio. February of last year, 96.8%. Where did we bottom out? We bottomed out, we've got 96.1. 96.1 December 2022 is when we bottomed out in this market cycle. The previous market cycle was December of 2008. That's when we bottomed out in the previous market cycle. We are only 1% under average for the month of February. When you look at the entire average for every February going all the way back to the year 2000, we are not that far off. Sold to list price ratio currently at 97.16. We peaked April 2021 at a staggering 109.46. The sold over list, can you believe that this month, 12.2% of properties sold over list price? That is slightly less than February 2023, but still a very good figure. Not bad at all. What about properties that sold at list? 19.5% of properties sold at list. That is slightly less than February of last year at 19.8%. And then under list, 68.3% of properties sold under list price. So here's the under list price, the average. So right now we're at 68.3. The 25-year average is 60.9. We're at 68.3, not that far off. The 25-year average is 60.9, and that's going to be this blue dotted line. That's the 25-year average. We're not that far. This is where we are. So we're slightly over the 25-year average. The thing is this, we all got used to this. This right here has never happened before. Hopefully will never happen again. That was insanity. But this is what we got used to. We have to remove this from our memory bank. We have to pretend like none of this right here ever happened. We just have to like, oh, that didn't happen. Let's just kind of keep on going with the trend. What about at list price? Take a look at this. The 25-year average for properties that sold at list price is 17.4. That's the dotted blue line. We're at 19.5. So we've got more properties that are selling at list price than the 25-year average. What about under list price? Yeah, this is at list. Oh, you're talking about this one? Oh, I'll change it. Okay, I'll change it. Thanks for pointing that out. I just updated this. Yeah, thank you. So this right here is under list. Okay, so the under list average, 60.9. I'll be sure to change that. I actually updated that this. I used to have this chart and this chart combined, and I separated these two as individual charts. So I'll update that. This one right here, we've got properties that sold over list. The over list average is 21.7. So we are slightly under, I'd say significantly under, the 25-year average. The 25-year average is 21.7. The number that we have right now is 12.2. And then, of course, we've got all of the top 30 cities. We have one city that is on the positive side. That's going to be Manchac at 100%. The rest are still selling under the list price. When you look at zip codes, we have 4 zip codes that so far for the property sold, the sold to list price ratio is over 100%. We've got 78724, 78729, 78652, 78605. So those are all the zip codes that so far for the month of February have an over list sold to list price ratio, over sold to list price ratio. So things are improving across the board. Sold to list price ratio is improving. Number of properties that are selling over list price are improving. And this is a metric that I've used for clients and for friends. Because what's happening is, and this is happening with all of us, is you've got friends, you've got neighbors, and they're like, wow, this other property, how's the market? I just heard that, some people are just getting crushed, or how's the market? And I'm like, we 12.2% of properties are selling over list price. That shocks people. They're like, wait, really? Yeah. But 1 in 10 properties are selling over list price. Now, a vast majority are selling under list price, but 1 out of 10 properties are still selling over list price. The demand is still there. People are oftentimes shocked to learn that at the absolute depth of the market correction of 2011, that 9.6% of properties sold over list price. 9.6% October 2011 sold over list price. People are oftentimes shocked by that. So, use some of this data just to engage in conversation with people that you know. Well, let's take a look at the bond market. Oh, we're now up 4.3 basis points. Slightly unfortunate that we are up 4.3 basis points. This is going to be interesting to see how this week plays out. I want to remind you that we have our mentorship meeting tomorrow, 10 a.m. I want to encourage you to join our mentorship meeting live in person, not recorded, because we do go over some, confidential information there, client-specific stuff. So I do not want that recorded. It's a very open, honest dialogue that we have within that mentorship meeting. So I want to encourage you to join that. Our main topic that we're going to be doing the entire year is going to be personality selling. How to sell to thinkers versus feelers. How to identify thinkers versus feelers. And I made a promise that for every agent that joins consistently that mentorship meeting, if you put into practice what we are discussing, what we are showing you, your sales will increase by 50%. I have no doubt. Your sales will increase by 50%. You are losing half of the potential deal because you're simply communicating to your client in a way that you're putting your client in a torture chamber. You just don't realize that. So we've got to learn how to communicate with different personalities, with assertive personalities, as opposed to creative or passive. We have to adapt. The client's not going to adapt to us. We ought to adapt to the client. So we've had a great time doing that. I want to encourage you to join us. We have Wednesday, our training. We're going to be doing the contract review for the previous week. So that's going to happen on Wednesday along with our training in broker Q&A. No meeting on Thursday. I love the fact that Thursday is the last day of the month because stats are going to be super, super accurate. And then Friday, we have our team price meeting. So be sure to join us for our live in person, also recorded Friday team price meeting. And that's going to be, gosh, hard to believe, March 1st. That is just insane. Are there any questions, comments, concerns, criticisms, or complaints? Questions, comments, concerns, criticisms, or complaints? Going once. Going twice. No questions, no comments, no concerns, no criticisms, no complaints. Going 3 times. All right, you all. Thank you all so very much. Super appreciate you joining. Have an absolutely amazing, amazing day. If you do need anything, please let me know. Here to help. Give me a call. And I will see you tomorrow for our mentorship meeting.